Well, let's get a check on Rivian. Those shares are falling despite beating revenue estimates and posting a smaller than expected loss in the second quarter results, down about 4.5% right now. Joining us now is Rivian CEO RJ Scaringe, along with our own Phil LeBeau. Phil.
Thank you, Morgan. RJ, let's start off with the second quarter. Smaller than expected loss. What are you noticing right now in terms of demand for your EVs in the market?
Yeah, we, as you saw for second quarter, our production was down. We made some changes to our production line to update the vehicle for our Gen 2 vehicles. But sales really exceeded what we produced because we continue to sell through our Gen 1 inventory. And we see a lot of excitement for the products. We're really pleased. Even just last week, we saw J.D. Power list us as the #1 brand in their annual appeal study. So we're continuing to see excitement around the product and certainly working to get more of those Generation 2 vehicles into customers' hands.
RJ, you end the quarter with just over $9 billion in liquidity. That includes $1 billion from Volkswagen with the deal you made in the quarter, and you've got another $4 billion on the way. Is that enough to get you through to R2 production in 2026?
We talked about this in the past. For us, the launch of R2 is really critical. It gives us a product that really allows us to access a customer that's much more price sensitive, to get us into that sub $50,000 price point. And the financing we have in place not only takes us through the launch of R2, but also takes us through positive cash flow.
It's great to have you on. I have an entire packet here of analyst notes, analyst questions, lots of them. Wall Street wants to know more about this VW partnership, what this looks like, why it's important, why it's happening now, the details around it, and how it's going to change the competitive landscape for Rivian.
This is something that we've certainly been at work at for a while, and it demonstrates the strength of the platform that we built, the electronic stack, the associated network architecture, and of course the software that's running on it. And we're really excited about the opportunity to take that platform between our electronics and our software and apply them on a global basis to a lot more products and to have that help drive the transition towards electric vehicles.
RJ, what do you see as the impact of perhaps a slowing consumer? Is your customer so high-end and your market share in the position where you don't think it has an effect on you, or does it perhaps make the availability of more affordable options more important?
Yeah, I think it's hard to predict exactly what happens from a macro point of view. Certainly, we're watching it very closely. But as it pertains to our flagship product, the R1, it continues to be one of the best-selling vehicles over $70,000. We see that continue to be the case, and the excitement around the product and what it offers remain. But very importantly for us, as I said before, is R2. And R2 really represents an opportunity for a step change in volume as we introduce something that has a price point starting at $45,000. And that segment really has very little choice. There's a lack of products for customers to choose from that are thinking about electrification. And we believe there's a lot of latent demand that's sitting on the sideline that's continuing to buy internal combustion or hybrid vehicles because there's just not a choice that fits their brand needs or their vehicle package needs.
RJ, one last question. You lost $32,705 per vehicle that you delivered in the second quarter, and yet you guys are still forecasting a modest positive gross profit during the fourth quarter. How do you get there?
Well, it's the move from our first generation to our second generation vehicle had a bunch of consumer-facing benefits. The vehicle is fundamentally better than what we produced with Gen 1. But importantly, we've talked about this now for a while, importantly, it drove significant cost improvements into the vehicle, both because of changes in the way the vehicle is built, but also in the way that we've set up our bill of materials, how we've negotiated with suppliers. And what we see for the Q2 numbers doesn't have any of these updated vehicles in them. And it also has the challenge of, for roughly a third of the quarter, 1 month of the quarter, our production was down. So we had an inefficient quarter as we made these significant changes to the vehicle, took down our manufacturing line, made big improvements in efficiency. And so we're going to start to see cleaner performance in terms of the new BOM's bill of material structure and, of course, the new operating structure, where the plant's now running at a 30% higher line rate than what we had previous to the shutdown.